Hello and welcome. This is the Quarter 1 2017 review for Fitbit. My name is Jason, and we will be going over the results of Quarter 1 in 6 main topics. The first topic is the company overview and the culture, and Nathan will be going over that. We have the fiscal overview, the financial overview of the company for the quarter, which Sean will be going over, the competitive strategy, and any changes over the quarter will be Krista. For growth and opportunities that the team feels, Julius will be covering that. Christopher will be covering the products and the services and the technical aspects. I will be covering the industry and the position, as well as the conclusion. To start off the quarter, we would like to go over a very old Aesop fable called The Dog and His Reflection. In this fable, a dog, after winning a bone from his master, goes wandering off into the forest and coming back home comes upon a pond. Now, in this pond, he notices another dog looking back at him, but with another bone. So the dog thinks, here I am with one bone, one prize already secured, why not go get another one? So the dog looks into the reflection, his own reflection, mind you, and starts to bark at the dog, trying to scare it to take the other bone. Little did the dog know, he actually dropped his own bone into the water and had to go home with no bones. For Fitbit, what we see is we're going after smartwatches, which is that extra bone. Let's focus on the dedicated fitness and let's focus on the healthcare application and securing that bone we already have.
Hello, my name is Nathan Pallett, and I will be giving you a quick corporate overview of Fitbit and providing you with some of the critical recommendations the team has come up with in our report. Let's start off with what is best for Fitbit. The bottom line is Fitbit should keep doing what it does best and was founded on, creating data-driven products that provide information consumers didn't really know they needed, but can no longer live without. Even over the last year, with increased competition, Fitbit holds a distinct advantage as the established incumbent in the fitness tracker market. The company even has an excellent history and opportunity to capitalize on its position in the corporate wellness market, as well as the health and medical field. Fitbit does not, however, possess the ability to jump into the smartwatch brawl that is happening between some of the tech heavyweights such as Apple and Samsung. Fitbit launched its first product just 9 years ago in the form of the Ultra. And just last month, the Ultra HR, which was launched with an increased capability to analyze people's sleep, something that really the company could only have dreamed of when the first tracker model was launched in the early days. Coupled with new products, the company has also targeted an all-of-the-above strategy to increase profitability and maintain its market share, launching a worldwide ad campaign while simultaneously restructuring itself, trimming down to better position itself for more advances in the smart wearables market. A real opportunity for growth lies in Fitbit's heavy use in the corporate wellness program field. The company already has a dedicated program focused on product use and is in great position to capitalize on growth taking place in the sector. Additionally, Fitbit can capitalize on the data-focused products that the health field is demanding currently, and play to the company's strengths in the past R&D developments, such as sophisticated heart rate monitoring and sleep analysis. Before moving on into some of the more detailed analysis some of the other team members have, I would like to share a recent story of a company that thought it was moving into the next logical phase of its development, but in fact turned out to be more of a disaster. In 1996, McDonald's introduced the Arch Deluxe. The logic was really simple when it came down to implementing it. They thought, we make cheeseburgers, so why not make a sophisticated cheeseburger equal to what some of our higher-end competition would be making? What ended up happening really turned out to be one of the largest corporate losses in history. McDonald's attempted to be something they were not, a high-end burger restaurant. The endeavor failed miserably and cost the company hundreds of millions of dollars. Even though McDonald's makes hamburgers, no one really associated them with making artisanal hamburgers. This really does compare with what Fitbit is thinking about doing in the smartwatch industry. Thinking about jumping into a market it thinks it belongs into, but nobody really associates them with. Thank you.
Hi, I'm Sean McCormick, and I'm going to go over our fiscal overview for our recent performance for Fitbit. 2016 was a very mixed year for us. I'll go ahead and start with some of the highlights. In 2016, we saw a 4% increase in the number of devices sold over 2015. Those sales were also at a higher per unit sales price of $94, which represents a 10% increase over 2015 prices. Accessory sales also significantly increased this past year. We saw a 118% increase year over year. This equates to an extra $3.36 of revenue per unit sold. Another highlight for 2016 is that new products sold well. These new product introductions represented 70% of our full year revenue. These trends, though, began to turn around in the fourth quarter. Fourth quarter average revenue per device, including accessories, was $88, up 2% year over year, but down $95, or from the $95 peak in third quarter. This revenue per device was negatively impacted by increased rebates and other promotions during the holiday season. Considering the fourth quarter has historically been the period where we have generated over 40% of our annual revenue, this quarter-to-quarter decrease is worrying. Now with the bad. In the fourth quarter of 2016, we recorded a loss of over $146 million, mostly due to a 24% increase in quarterly operating costs coupled with a 19% reduction in fourth quarter revenue. These increased operating costs resulted in gross profit margins in the fourth quarter of 22.1% versus 48.9% in the fourth quarter of 2015. This loss, which is the first since the fourth quarter of 2013, has resulted in significant decrease in stock price and investor confidence. Now I'd like to discuss some of the reasons on where this increased operating cost came from. Looking not just at the fourth quarter, but full year spending, as we ramped up in efforts to enter the smartwatch market, research and development expenses increased over 100% year over year. Further, the efforts to advertise our newly released products and upcoming products has resulted in a sales and marketing expense increase of 47%. Lastly, general and administrative costs have increased 48% year over year. In all three of these categories, most of these increases were a result of increased headcount. The sum result of this increased spending was the overall operating expenses increasing year over year by 62%. This has led to an unacceptably low gross profit margin of 39.3% for the year versus our long-term gross profit margin target of 45%. These trends must be reversed, and decreases in headcount as well as more efficient and reduced spending across the board will allow us to do this.
Hello everyone, my name is Krista Clother, and I'm part of the Fitbit executive team. Based on what's happening today in the market, I wanted to make sure we took a few minutes to talk about the competitive landscape that we're currently facing as a company. As you can see on my screen here, as of 2016, Fitbit currently leads the global wearables market. But in order to stay in place as the market leader, we will need to carefully consider who is worth competing with. We, as an executive team, recommend that we keep our focus on the dedicated fitness and explore the chronic health market further. Let's begin by talking through what we currently see today. The competitive landscape is vast, and when we began our company back in 2007, I don't think we could have predicted some of the competitors that we face today, which is precisely why our product and research and development teams are always keeping a pulse on what's happening in our specific fitness wearables industry and others we may not have initially suspected. We're facing competitors from many different angles. First, let's look at the general consumer electronic competitors. This segment of the market includes companies such as Garmin, Jawbone, and Misfit. These companies and their products are direct competitors for us in the wearable fitness technology solutions. We go head-to-head with these competitors with many of the same features, the information that we allow our consumers to track, and the technological advancements that we've been able to work into our products. Next, I'd like to bring up the health and fitness companies. These companies, such as Adidas and Under Armour, compete in this space with us kind of as a secondary focus. Adidas and Under Armour have long been focused on fitness equipment and apparel, but recently have been exploring the wearable fitness tracker market further. Under Armour in particular has a wearable technology that closely resembles our Fitbit Flex in size and in features and appearance. We can't forget to talk about our traditional watch companies either. Brands such as Fossil and Movado have long been in the watch industry, but recently we've seen them expand their reach and the capabilities of their products to include tracking of different health needs such as steps, sleep, and heart rate. It would also be remiss not to mention our fearless low-cost competitor, MyBand. MyBand prices their one product at an extremely low price, but minimizes on features and customization in order to keep costs low. Last, and most certainly not the least of the competitors that we should be concerned about at Fitbit, is the smartwatch technology market. Companies like Google, Samsung, Apple, LG, and Microsoft all are competing in this area with broad-based technology that just so happens to include some basic fitness tracking features such as steps, sleep, floors walked, and calories. Now, with all of those competitors in mind, you may see how it could be easy for us at Fitbit to look at the reflection of what else is out there instead of focusing on the bone we have, like Jason illustrated earlier. Even though the smartwatch technology market appears shiny and exciting, like the dog's reflection in the fable, we believe this would not be favorable or a favorable route for our company, as this market already appears to be oversaturated. It would also pull us further away from the wearable fitness technology market, which is the bone that we have and the bone that we're already really, really good at. As an executive team, we believe there is a need for us to refocus in 2017 and really focus on the areas that we know well, while investing research and development dollars into two areas that we believe make more sense and fit our current bone a bit better. There is a large opportunity in the dedicated fitness and chronic health market. Now, when I say dedicated fitness, I'm referring to Olympic-style athletes, triathletes, swimmers, bikers, people who are dedicated to their sport and looking for the right technology to help them elevate themselves in their training. In addition to dedicated fitness connoisseurs, the chronic health market is also something we need to consider. When I say chronic health, I'm referring to a disease such as diabetes, where the consumer needs to track certain areas of their lives in order to maintain their health. Up next, we're going to dive in further to that specific opportunity. Thank you.
Hi, my name is Julius Samara, and I'm presenting my portion of the report on growth opportunities for Fitbit. I'm going to show you areas of potential growth in the chronic disease markets. Imagine just taking simple steps can be a cure for a devastating disease like diabetes. In fact, did you know that taking 10,000 steps a day can help control blood glucose levels in diabetics? My first slide shows you the various chronic diseases. Chronic disease account for up to 80% of all U.S. healthcare spending. These are just some of the costliest chronic diseases, with diabetes leading the way. The clinical trials using Fitbit, 39 in all, are measuring biometric activity in various chronic medical conditions. As more of these studies are published in the upcoming years, healthcare providers will get a better sense of how to utilize these data into their practice. My next slide shows you the the prevalence of one of the chronic conditions, diabetes. So far, North America is the #1 selling region for Fitbit, accounting for about 49% of total revenue. However, Europe and Asia Pacific are projected to be the next target regions, which makes sense because diabetes in these regions are growing at a faster pace than most other chronic conditions. My next slide shows you the potential revenue of certain chronic conditions. We feel medical conditions which require the importance of physical activity will be the most lucrative for wearable devices such as Fitbit, with diabetes leading the way worldwide. Looking down the road ahead, we feel the outcomes of the clinical trials could catapult Fitbit back into its earlier successful years. However, with the fierce competitions, we recommend Fitbit stay out of direct competitions in the smartwatch markets and just focus on smart wearables dedicated not only to health and wellness, but also into the chronic disease markets. Like a golfer in a slump, Fitbit is experiencing a slump and needs to rediscover its authentic swing. A swing that once defined the company and the products that they perfected. Thank you.
Ladies and gentlemen of the Board of Directors of Fitbit, my name is Chris Murray, and I will be delving into products and services for the company. Before I do, my outlook for Fitbit is that if they do not innovate or produce any new products, they will find it very difficult to see their stock prices and values rise in the future. I believe it will continue to decline, and as it has been doing for the last year over year. Their primary revenue is derived from their fitness and activity trackers. There is about 7, and they basically do all the same things. Measure your steps, how many steps you walked and climbed, your heart rate, the quality of your sleep. And they range from anywhere from $60 to $250, and they mainly are for their wrist as a band or maybe as a smartwatch, and also as clip-ons as well. This year they released, last month, March, they released 1 new product, and last year in 2016 they released 3 products. But you know, that's not going to do it, as well as the deep discounts they're offering for their merchandise. It's indicating a severe demand problem for their stock. Even the new product that they just released last month, you know, even though it's getting good reviews, the category has plateaued. And just people, they don't want, they already have trackers and they don't want a new one. You know, the bottom line is that this new product that they just released last month is not medically accurate. The consumer market is saturated already, and things aren't changing with that. When Fitbit had launched their IPO back in 2015, their shares started at $20, and then that went to $30, and within a month of trading, it went to the mid-40s. Now in 2017, their stock value is down to $5.75, and it continues to drop year after year after year. You know, they're trading at 70% below IPO price and 89% off of all-time highs. And you know, their sales, even though it increased in 2016, you know, their margins shrunk from 40.5% to 39%, which led to lower gross profits and net incomes. They expect for fiscal year 2017 that their sales range will be 1.5 billion to 1.7 billion, but year over year that's a decrease of 22 to 31%. So as you could see, the trend here is that things are continuing to decline for the company, particularly their stock prices and values. Just recently, a couple months ago for 2017, they laid off about 100 employees. But despite that, they're still injecting a lot of money into their research and development area. They even just hired a tech veteran, Jeff Devine, who previously worked at Cisco, Hewlett Packard, and Nokia, and he's going to start overseeing, Fitbit's operations, customer service, and quality control. But I think that this is not enough to save them or to pull them out of the deep water that they might be in if they don't look to innovate. If the company doesn't innovate or bring out new products, it's just going to be really, really difficult for them to turn back. My recommendation is to perhaps consider hiring a larger creative team than just one individual. Some new ideas, new blood, on the scene that might be able to inject, something different into the product line right now. Right now, Fitbit is, is a small company in a large market with big, competitors like Apple Watch, and then also there's Android Wear as well. There are other, smartwatches and things for your wrists, like Xiaomi and Garmin and TomTom. But if Fitbit doesn't look to innovate or bring out new products, it's just going to be really difficult for them to make a turnaround. Basically, that's my recommendation, and that's it for products and services. I do wish you all have a great day. Thank you. Bye-bye.
Everyone, once again, this is Jason Catalano, back from the Dog and his Reflection. So I'm going to be covering the industry, and for quarter one, there are two major changes within the industry as well as one minor. The two major have to do with strategic positioning of major brands as well as in the regions, and taking a look at the three main regions of North America, Europe, and Asia. And the third reason is going to be a kind of minor one, will be for the applications based, just looking at for an industry-wide, looking at the sales for sensor and sensor technology. So first, let's go over the industry position. What we notice is that first, Fitbit is moving more towards the middle on our strategic map, where it's either going to be consumer or enterprise, and we're looking at either being a premier pricer or we're looking at being a commodity. Currently, Fitbit is a little more on the consumer side, but we're starting to see a lot more enterprise applications, and currently Fitbit, after the quarter, has moved to the middle. Microsoft, with the Flex Alliance, is shifting hard towards the enterprise, and it looks like they can charge pretty good rates. They are looking to secure the enterprise, as there's not that many competitors looking into that field. Garmin moving much more towards consumer, as well as Jawbone now moving more into the enterprise, but more of a commodity based. As you can see in the industry, though, it's very tight in terms of the consumer, with major brands such as Nike and Apple, Samsung, and Garmin, Sony. All of them are more consumer based, and we're having a few of the major brands also in the premier pricing. So once again, Microsoft major shift into the enterprise, Apple, Nike staying fit. For the regions, what you're going to see is for North America, we have 49% of sales are coming from there, 15% are coming from Europe, as well as 7% from Asia. Most of the rest is coming from the South Pacific, primarily Oceania. So for North America, the primary thing is 46% compound annual growth rate for sensor and sensor technology. Clearly, there's a market for people trying to just obtain the raw data of what their body is telling them versus a smartwatch application, which would be much more encompassing. Think of more of like a phone on your hand. In terms of Europe, we're seeing 64% sales increase from last quarter. This is very important. Clearly, Europe is now starting to get into more of that early adopter, maybe even early majority in terms of where they are on the adoption. For Asia, we see a contraction of about 45%. Although a lot of markets are saying that Asia is going to be a very big market for smartwatches, as well as a rising middle class, we do not see the dedicated fitness or healthcare application really taking off there yet, and that is a much more long-term project for Fitbit. And we suggest moving more towards North America, where we know we can secure a foothold within the consumer application as well as the healthcare. So now on to our conclusion. So going back to the beginning, the dog and his bone, we definitely suggest going more towards the dedicated fitness, which you can see here with the triathletes, and the healthcare, which you can see only diabetes being truly tapped into as a market. We suggest going into those, and with the stories, we see with the dog and his bone, that is going to be our primary bone. If we start chasing smartwatches, start chasing different type of technology that we can't really compete yet in, it's only going to drive up those operating costs. It's only going to drive up the R&D. And McDonald's, clearly a story to watch out for. When we go off brand, when we go off what our core competency is, we can lose hundreds of millions of dollars. And we do not see that being a problem if we stick to the dedicated athlete, if we stick to the healthcare applications. With that, I'd like to thank you. And if you have any questions, please feel free to contact myself and our team. Go ahead and contact us with our emails. Thank you.